One of the biggest retirement planning mistakes I see university professors and administrators make is assuming that retiring on June 30th is just another retirement date. It isn't. Here's why. Unlike many private companies that naturally think in terms of the calendar year, colleges and universities typically operate on an academic and a fiscal year. For many institutions, the fiscal year ends on June 30th and the new fiscal year begins on July 1st. That's one of the reasons it's so common for university professors and administrators to retire at the end of June instead of December 31st. It aligns with the university's fiscal calendar, the end of the academic year, and often the conclusion of teaching or administrative responsibilities. Now, at first glance, retiring on June 30th may not seem much different than retiring on December 31st. But from a financial planning standpoint, it can create opportunities that many retirees outside of higher education simply don't have. Let's use an illustrative example. Susan is 66 years old. She's a university administrator earning $150,000 per year. She's planning to retire on June 30th. Most people think, great, I've picked my retirement date. I think that's when some of the most important planning begins because Susan only has 6 months to maximize her retirement plan contributions. She may be able to reduce her Medicare premiums after retirement. And because she's only working half of the calendar year, she may have an opportunity to complete a Roth conversion during one of her lowest income years. Those opportunities exist because she's retiring in June, not December. That's why I tell university professors and administrators all the time, don't just plan for your retirement date. Plan for the planning opportunities your retirement date creates. Now let's walk through Susan's situation. Remember, Susan earns $150,000 a year. She's retiring on June 30th. The first planning opportunity involves her 403B. Retirement planning contribution limits are based on the calendar year, not the university's fiscal year. Normally, Susan has 12 months of payroll to reach the annual IRS contribution limit. But because she's retiring halfway through the year, she only has 6 months of paychecks. If she waits until April or May to think about increasing her contributions, she may simply run out of payroll. Let's assume Susan wants to maximize her retirement plan. Instead of spreading those contributions over 12 months, she may need to significantly increase her payroll deductions beginning in January so she reaches the annual contribution limit before her final paycheck. I've seen people miss this opportunity simply because they didn't realize retirement plan limits follow the calendar year, not the academic year. Now let's move to Medicare. Susan's retiring after the age of 65. One of the first questions becomes, when does my employer health insurance end and when should my Medicare Part B begin? That's not something you want to figure out after retirement. Missing Medicare Part B enrollment deadlines can result in permanent late enrollment penalties. So this is something you should begin planning several months before your retirement date. Now let's talk about Medicare premiums. Susan normally earns $150,000 a year, but because she's retiring halfway through the year, she'll only receive approximately $75,000 of salary. Let's assume she also has $15,000 of dividends and interest. Now her projected income for the year is approximately $90,000 before considering any additional retirement income. Many retirees don't realize Medicare premiums are generally based on prior tax returns. That means Susan's Medicare premium may initially reflect her higher working income instead of her lower retirement income. Fortunately, retirement is generally considered a qualifying life-changing event for Medicare IRMAA purposes. With the appropriate documentation from her employer and reasonable income estimates, she may be able to request a new Medicare premium based on her retirement. Here's another point that surprises many people. Let's assume Susan retires in June. Medicare starts in August. She forgets to submit her IRMAA reconsideration until November. That's okay. If the request is approved, Medicare may adjust the premiums and refund excess premiums that were paid earlier in the year. So even if you don't complete the paperwork immediately, it's still worth addressing. Now let's move to what I think is one of the biggest planning opportunities. Roth conversions. Because Susan only worked half of the calendar year, this may be one of the lowest income years she'll have for quite some time. Let's assume her projected taxable income is approximately $90,000. That naturally raises another planning question. Should she convert some of her traditional retirement account to a Roth IRA? Maybe. But here's where planning becomes important. A Roth conversion increases taxable income. Higher taxable income can also affect future Medicare premiums. So now you're balancing between two objectives. Do you keep income lower to potentially reduce Medicare costs? Do you intentionally recognize more income to complete a larger Roth conversion? Or is there a middle ground where you accomplish part of both goals? There isn't one answer that's right for everyone. That's why we run tax projections before retirement. Sometimes a smaller Roth conversion makes sense. Sometimes a larger conversion is worth accepting higher Medicare premiums because of the long-term tax benefits. The important thing is making an informed decision based on projections, not guessing. Finally, don't overlook retiree benefits. Many universities historically offered retiree medical benefits. Some still do, others have modified or eliminated those programs over time. Don't assume the benefits are the same as they were for someone who retired 10 years ago. If you're planning to retire on June 30th, contact your human resources department earlier in the year. Find out exactly what benefits you're eligible for. If you need supplemental medical coverage or retiree health insurance, you'll have time to compare options before your retirement date instead of making rushed decisions during your final week of employment. So, what's the biggest takeaway? Most retirees spend years planning how much money they'll need in retirement. University professors and administrators also need to think about when they retire, because retiring on June 30th instead of December 31st can create planning opportunities involving retirement plan contributions, Medicare enrollment, Medicare IRMAA, Roth conversions, and retiree benefits that many other retirees simply don't have. The earlier you begin planning, ideally in January, for a June retirement, the more opportunities you'll have to make informed decisions. If you found this video helpful, I'd really appreciate it if you give it a thumbs up, subscribe to the channel, and share it with another university professor or administrator who's approaching retirement. My team and I specialize in helping university professors and administrators make informed retirement decisions, particularly those with TIAA retirement plans. Whether you're evaluating retirement income, TIAA distribution strategies, Roth conversions, Medicare, tax planning, or coordinating with your CPA, our goal is to help you make informed financial decisions and retire with confidence. Thank you so much for watching. And remember, for many university employees, retirement planning isn't just about choosing a retirement date, it's about recognizing the planning opportunities that retirement date creates. I'll see you in the next video.